Stocks are ripping and sentiment is dipping. Are we in a recession or about to be? There are multiple recession indicators, or at least you would think there are if you hang out on TikTok. Yes, the Zoomers are talking about undeniable recession indicators. We get into that and then back it up with some hard data, or rather, don't back up with some data here on Bitcoin Season 2. Let's kick it off.
My boy hitting dingers, stocks ripping, sentiment dipping. All my homies are tripping. Can't buy a house, can't afford a baby. We gonna get a recession? I don't know, dog. Maybe. It is real recession hours on the socials for the most Americans, but the market is telling a completely different story, Charlie. It's like the tale of two markets right now.
Yeah.
And this has been top of everyone's mind, especially after April when Trump announced Liberation Day with his reciprocal tariffs. And this has kind of been the perpetual story and kind of like a bait and switch thing in the market and within, people's news digest, right? Because like everyone thinks it's going to happen. They think it's just around the corner. People think things can't go any higher. Everything's super expensive. But so far, we have avoided the worst. Some are calling for a soft landing. Others are saying it's too early to tell. Who do you know to trust? You can't really trust anyone because ultimately no one knows. Recessions are always like backward looking. You don't really know you're in one until you're in one.
It's like the good old days, but the bad old days. And you didn't know you're in a recession. We're structuring this episode as first we're going to show you what the internet is saying about the recession. And it's more vibes-based evaluation of recession. And then we can go to the data, which, again, I guess is data. At the end of the day, everything's kind of vibes-based. But it really does like further showcase the siloing of different like worlds and the different experiences of people, whether you're a young person, a Zoomer wanting to get on with your adult life, or whether you are some degen trader who is absolutely killing it on Robinhood. There's like, now you can totally exist in one world and never cross over with the other. So,
and you're right about it being vibes based, even with these statistics. Recently Trump let go of the Bureau of Labor Statistics head. And the headline with that was because he was mad about the numbers for July. But part of it also is if you look at the July numbers, they revised May and June's collectively down by like 250,000 jobs, which eliminated like 80% of the job growth for those months, right? So when I saw that, I just had this thought that it really is, even for the professional investors, you're kind of just throwing darts at the board based on vibes because some of the numbers are fake, but it doesn't matter if they're fake if the majority of market actors act like they're not, right?
Yeah.
But anyway, we're not going to get into the vibes for the professional trading class. We're going to get into the vibes for the hoi polloi, the common man, the TikTok class.
Yes.
Who feels like they are seeing red warning signs flashing in every DoorDash order and in every corner of the street.
Klarna is a big thing. If you are a young person these days, that's where you basically take a loan out to buy a Chipotle burrito. Yes, that's a thing if you miss that whole narrative, but maybe you're just insulated from it. I mean, so let's kick it off with one of Colin and I's favorite like niche topics, which is recession pop. And that is this idea. It's got a Wikipedia page, so it's a real thing. Recession pop is an informally defined style of music predominantly associated with the dance pop and electro pop that emerged during the Great Recession in the United States, late 2000s, early 2010s. It sounds like this.
Electronic beats. I got the pop music with the future flow.
Yeah, so that was a mashup of, Black Eyed Peas, Lady Gaga, Katy Perry, LaRue for a deep cut, Tao Cruz, LMFAO. That's like that like heavy, like oversaturated, we're gonna party like it's the end of the world kind of pop. Now you see like a lot of cultural commentators, and this actually was the era for any of you old hat millennials of like Pitchfork being the absolute tip top of like music and culture commentary, that Chicago based hoity-toity indie rag. And they would always be, poo-pooing on, say, the Black Eyed Peas. But what's funny is, 15 years later, it's quite common, especially for the Zoomers who were just barely alive at that time, to think back to this music as nostalgic. And I think this may also be the case for millennials as well, because you had a very no cares in the world. This is the last era before cell phones permeated every part of society, and you could go somewhere without somebody to take a video of you looking dumb. But recession pop, as this TikTok carousel describes, if you are watching this, recession pop is very much a particular era in modern pop music that happened during the Great Recession post the financial crisis. And so you see some fun stuff like that. Colin, I'll throw it to you. Recession pop, it's back. It's coming back. So I don't know if you've been listening to like the kids these days, but they're now starting to make, unabashed SoundCloud sounding, pop music. Hyper pop's kind of a thing now.
Is Billie Eilish a post Great Financial Crisis phenomenon? That's kind of my takeaway from this.
Maybe for the deeper cuts, maybe like 100 gecs, but that's might be a little bit. Yeah,
Billie Eilish was way too far removed for this. But you made a good comment before we hopped on the horn about that. A lot of like the concept of recession pop is really the listener transposing their feelings on the music and what they decide to consume rather than the artists. I think that's probably true with some of this. I do think, though, you will see these cultural elements reflected in music, like when people were generally feeling despondent and economically disenfranchised, like it will reflect in the art in some ways. But I don't really listen to pop music that much, so I don't really know what's going on in recession pop land right now. I will trust your ear to the ground on that.
The answer is yes and no. I mean, my view is like now the music landscape is so multifaceted and varied that all the trends are happening all at the same time. So you can divine whatever meaning that you want. But on TikTok right now, all the kids are talking about recession pop as being huge. And the Zoomers they are embracing it. So it is actually, Colin, it's our time to shine. Tao Cruz and the Black Eyed Peas are, dare I say, coming back among the Zoomers. So it's about time,
It's a boomerang.
Yeah, so time is a flat circle. Here's another one. Again, I would say this is not like a particularly interesting TikTok to me, but this is like another another type of TikTok. So if you're listening, it's some chick, with a bit of a vocal fry, if you know what I mean, talking about recession indicators and the rich.
The rich don't want to be near you. I truly believe, and I'm seeing signs of this everywhere, where there are like new levels of exclusivity as people are like climbing the social ladder and trying to be around the rich, trying to be rich, all that stuff, trying to improve their lives. The people who are already in there, like the established rich and established wealthy, are moving away. There's like new tiers opening. Like airlines are now having more exclusive lounges that you can't get into with cards. Like it feels like each time the 90%, the 99% break that ceiling, or at least crack it, the rich build like another level with another glass ceiling. I don't know. It's really funny. And I think it's about to be even more severe now that we're kind of in decline.
Where has this woman been? I mean, I don't know who that, she seems like a nice person. I don't know how old she is, but like it's always been this way. It's the ultra wealthy have always found ways to insulate themselves from the unwashed masses, right? And they've always had access to exclusive experiences and spaces that are just gatekept from the rest of us for want of money, right? The airline thing is one. I've personally never seen lounges that weren't. I mean, but the card ones aren't even worth going to anyway. You get like a cafeteria lunch and there are like 50 people in there all battling for armchair space.
That's a recession indicator, Colin.
And I mean, you know what? Maybe. I find this to be one of the weaker ones, just because I feel like this is just this is the story of human history and progress. Like, the rich have always found ways to separate themselves into not just another class, theoretically, but literally another class spatially.
Yeah, and the funny thing is, like, your response to this, I think we can after this take a look at the data and say a lot of the recession indicator is in the eye of the beholder. Like, do you feel like there's a recession? Because that's sometimes what is the only thing that matters. Okay, one more, and I'm going to subject this to everyone. Here's a funny one. Please don't cancel me for it, but here's a funny one.
Recession indicator number 59. I ordered food last night. Opened the door, delivered by a white woman.
Well, what's funny is, like, that's actually not a bad indicator. Is this idea that people who are typically not taking up the gig work are taking up gig work?
Yeah,
it's just comedically framed,
comedically delivered, for sure.
Yeah.
Yeah, I think that one would be a stronger one, just in the sense, like you said, if you're, it could be anyone in this scenario, right? It could be someone in a white collar job that then has to do gig economy work because they can't get a job in their field of choice. Obviously, this is something that people are pretty worried about with regards to AI. We've already seen AI have impacts on certain industries. I believe, what was the company recently? It'll come to me in a minute, hopefully, where they announced that they were laying off like almost all of their HR staff because they don't need humans to do those mundane tasks and clerical things.
Resources.
Computer resources, AI resources. Yeah. And that's obviously, AI is front and center of this conversation. There's a lot of doomer and white-pilled takes on what this is going to do for the productivity of the economy. But it's hard to look at it and not think that there are going to be a lot of jobs shaken up from it. But we're not quite seeing that in the data yet. And it's impossible to say when you parse it whether or not these are jobs lost because of any other factors like tariffs, generally just a slowdown in those sectors, or if it's because those jobs are being replaced by, our future overlords in the AGI space. But maybe we can hop into some of the numbers, unless you have one last thing to add.
No, that's it. That's all I'm going to subject you for the Chinese spyware that is TikTok. So you've got your annual dose of TikTok, and now we're going to wrinkle your brain a little bit with some data.
Yeah, so we teased you with the fun cultural elements. Now we're going to get into the boring numbers. I'm playing the boomer to Charlie's Zoomer on today's Writer's Room, which is typically the case, actually. But so just to set the stage, we're going to be looking at expectations for a recession in 2025, and then we're going to be looking at what the market has been doing. Q2 earnings just came out, I believe, as of last week. FactSet reported like 90% of S&P 500 companies that reported earnings. They did well above what expectations were. And we will have the full outlook for that, not this week. I think the final companies will be reporting in the last week of August, but safe to say with 9 out of 10, we have a pretty clear picture of what productivity and earnings are looking like for these companies. Then I want to jump into the real economy and look at job numbers, because I think that's one thing that kind of is creating the skewed perception between certain classes of investors and employees in the US, right? A recession is typically defined, right, depending on who you ask, by the stock market declining and entering a bear market over a certain period of time. And obviously, you would expect that to happen if productivity was down and jobs were not strong. But the stock market is not reflective of the underlying reality for a lot of people, right? Like, the real recession kicks in when people are losing jobs and unemployment is going through the roof. So we'll look at the job numbers, and then we'll also look at a few other things like CPI and PPI and a few other data points that I've pulled up. But in terms of recession risk outlook, the Wall Street Journal published a survey of economists recently that showed improving sentiment actually for recession odds. So I think during a lot of the tariff fear mongering in April and May, when the market was getting absolutely nuked, everyone and their grandmother was saying recession imminent. There's no way we don't get one in 2025. Market bounced back. Job numbers came in stronger than expected. Earnings came in stronger than expected in Q2. And people just kind of forgot about that. There's still people out there calling for it, but right now it's weighted more towards there not being a recession. So the Wall Street Journal found that the recession probability, according to its basket of economists over the next 12 months, has dropped 33%, down from 45% in April. Q4 GDP is now expected at 1%, which is not amazing, but it's not negative, right? Modestly raised from previous forecasts and backed by steady job creation. It says averaging 150,000 jobs a month. I don't know where that's coming from because recent job numbers, maybe the average is that for this year, but recent job numbers have been nowhere near that. And stable employment around 4.1%. Unemployment has stayed sticky for the last few months. It's been hovering just above 4%. There hasn't been anything moving upward in that direction that would potentially create some warning signs for consumers and investors. But as the Wall Street Journal points out, economists are a little bit divided. Goldman Sachs has the recession odds at about 30%. BCA Research is the most bearish, has it at 60%. The economist Torsten Sloak fears a voluntary trade reset recession has a 90% probability, which is super massive. And looking at some of the other expectations in terms of GDP growth, Goldman Sachs forecasts 1.25%. Ernst & Young is expecting a 1.5% increase to GDP, which is a slowdown from the 2.8% in 2024. And they're pricing in a 12-month recession risk at 35%. So some of these are even looking into 2026 for the first half, and they're saying they don't see it then either. Bank rate economists estimate a 35% chance of recession over the coming year, slightly lower than last quarter's 36, so not too much. With job growth cooling and unemployment possibly rising to 4.6% by the middle of 2026. So where are they getting these forecasts, right? They're looking at bukus of data, and they are looking at a lot of these reports from the government in terms of labor data. They're also looking at what the market is doing. So I want to go ahead and pop on over to FactSet's most recent report on S&P 500 earnings. If y'all don't follow FactSet's work, I highly recommend it if you're trying to get a look at some of the macro forces that steer things. But just to highlight something that they pointed out in the report that I thought was really interesting, the number of S&P 500 companies citing recession on an earnings call, this is the 10-year view, and it just completely drops off a cliff in Q2. We're below 25 mentions in these calls, whereas in Q1 it was at nearly 125.
Yeah,
and then,
me just looking at this is wild to see.
Yeah,
where last quarter, of the S&P 500, 125 of them, and then this quarter back down to, it's like if you just looking at this, you see no trend. You have this massive spike in a quarter. It's like almost like everybody hallucinated this, and it's wild.
And it's good. That's a good thing to point out too, because if you look at this, right, when else were they calling for recessions? Well, the highest read on this was in Q2 2022, and the market was in a downturn. I mean, I'm pretty sure over 2022 the S&P shed something like 20%, around that, maybe even a little bit more. I mean, it was a massive drawdown, but we didn't actually get a recession, right? Remember back then, a lot of people were screaming for it. It's like, this is when the music stops. This was when the Fed started to aggressively hike rates, to address the COVID fiscal stimulus-induced inflation. And then the other time that it was cited the most outside of that read was in Q2 of 2020. Obviously, in the full swing of COVID, we did get a flash recession there. That was you don't want to call it artificial because COVID was a real event. But that recession was very short, and it was obviously in response to lockdowns from COVID. And, depending on where you stand on the aisle, that could have been avoided if the economy wasn't forced to grind to a halt, right? But looking at some of the other stuff from FactSet, they look at the earnings for all these S&P 500 companies, and there are some salient insights if we look at the industries that did well versus did not do well. So just a quick recap from this report from FactSet. 90% of S&P 500 companies have reported Q2 earnings, and 81% of the reported companies surpassed expectations in Q2. The S&P 500's blended average earnings growth increased 11.8% year over year. Revenue rose 6.3% quarter over quarter, which was the highest quarterly growth since Q3 2022. Again, Q3 is when we started to see a rebound from that 2022 sell-off. And that's above the 5.7% average, that quarter over quarter revenue growth. Given this, FactSet's, the analyst that FactSet cites, they're actually raising their forecast for Q3 for earnings growth to 7.2% and 7% in Q4 and 10.3% overall for 2025. So when you see something like that, when these economists and analysts are saying we expect strong growth throughout the rest of the year, that number one is going to point people towards, there's not recession risk in the immediate future. And I'm not saying that we won't have one, but right now, a lot of people who look at the numbers are saying there's no real reason to expect it, at least in the near term. But what I find the most interesting about this, and this is not surprising given the tariff schedule, but if you look at the earnings growth, surprise, surprise, communication services and information technology, i.e. tech, are blowing through every other industry. The earnings growth year over year in Q2 for communication services was about 45%. And then for information technology, it was like 21%. And then the third largest growth came from financials. Bankers always get theirs, everyone. It's about 11 or 12% year over year. But if you go to the tail end of this chart, you can see that the energy sector got absolutely hammered in Q2. The earnings for collectively for the sector was about negative 18 to 19%. And then materials also was negative 3.7%. So I find this super interesting. You should expect this from materials, right? Input costs are going up for manufacturing. Demand is going to slacken if those prices rise above the threshold that consumers find reasonable. So that kind of makes sense. But energy is a leading indicator for recessions in almost every single case. If you look back, right? If there's less demand for oil, less demand for natural gas, less demand for energy on the whole, then productivity typically slackens as a result.
Yeah, I mean, this is the Bitcoiner take, which is eventually it all does come down to some energetic throughput. And this is also, mind you, in the face of everybody saying there's an energy bottleneck for data centers. So
this is mainly like oil. So that's the one thing I would say with that is this is oil, gas, and things of that nature. And if you think about the fact that, imports are being affected by the tariffs, consumption might be down as a result, although the numbers are not actually, they don't really align with that. But oil has been taking a hit recently. I think at the beginning of the year, it just had multiple weeks of negative of sell-offs, right? But if there's no demand for oil, then there's a decrease in the velocity of services and goods, right? Typically. So if there was one indicator to look at out of these earnings, that would be the one thing that's flashing yellow in my mind. If you see the fact that oil and gas companies are just not not moving inventory like they used to, the price of oil is down. And part of this is also OPEC Plus is going to increase production in September. So with more supply coming on the market, that doesn't always mean that it's not being consumed. So that's another caveat there. But the whole FactSet report's 34 pages. I'm not going to go over all of it. But the kind of takeaway here is that earnings growth last quarter was positive for 10 out of the 12 sectors that they track from in the basket of S&P companies, except for materials and energy.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin.
moving on to some other data. One other note on Q2 earnings. Magnificent Seven, which is, the tech stocks that people usually think about.
They keep changing the name from
it used to be Fang, right?
Yeah.
But then Netflix was not, it's actually not that groundbreaking because everyone can launch a streaming service. But the Magnificent Seven is Google, Amazon, Apple, Meta, Microsoft, Nvidia, Tesla. But if you look at FactSet's numbers, and this was cited by John Hancock in a research note, Magnificent Seven is suspected to have a blended average growth rate of 25.7% year over year in Q2. And NVIDIA hasn't reported yet. They're reporting, I believe, August 27th. So we'll get a fuller picture and we'll know for sure what that blended average growth rate is. But that just goes back to, if you look at some of the analysis of the S&P 500, these stocks are, accounting for the majority of the growth over the last few years, and they are way overweight. The S&P is way overweighted to these stocks because they are the ones really moving the market right now. If you look at all the other stocks in the S&P 500, they had a 6.3% growth rate year over year. So still good, but clearly the Magnificent Seven is really moving the needle for the S&P 500 in this regard. That's another thing that people often point to where, it's all smoke and mirrors. If you just have these stocks basically boosted by AI hype and tech hype, right? For, that's not really indicative of the real economy. And that goes back to the materials and energy side of things, right? Like that's the bedrock of productivity and historically had been the bedrock of the US economy, manufacturing. But those are not doing nearly as well as the communication services and information technology. Okay, so let's go into unemployment numbers. This is where I think a lot of people are starting to turn their heads a little bit. So July employment numbers came in at 73,000 non-farm jobs added last month. And healthcare accounted for 55,000 of those, which is crazy. And now that is net from healthcare, right? So it's not, when you look at how many jobs were added, healthcare accounted for 55,000 of the net jobs added, but you can look at some of the other ones and they still added quite a bit, but others, were weighing down. So you can look at the numbers and see, well, these sectors all added more than 77 or 73,000, but that's because a bunch of other sectors lost jobs. Anyway, healthcare accounted for 55,000, followed by 18,000 in social assistance, 15,700 in retail trade, 15,000 in finance, 5,000 in leisure and hospitality, and 5,800 in private education. There's 3,600 in transportation and warehousing and 2,000 in construction. Meanwhile, employment in these sectors fell, a loss of 14,000 in professional and business services, looking at you, AI, 12,000 in federal government employment, looking at you, Doge, not surprising there. 11,000 in manufacturing. Ooh, not what you want to see if you're looking for strong job growth and, a non-recession indicator, and 7,800 in wholesale trade. July numbers belie kind of the truth about where the job market is, because it's okay, 73,000, that's, not good, but it's not terrible. But they revised down May and June's numbers collectively by 258,000. So June's numbers were revised down from 144,000 to 19,000. And May's were revised down by 133,000 jobs from 147 to 14,000, which is a crazy error. And this goes back to what I was saying about the vibes based analytics. How are you off by a factor of, almost 10 on your reporting for these things? And when you look at something like that, you have to ask yourself, can we even trust these numbers? Because they're extrapolated, right? They're not going and surveying every single business in the US. They're taking what data they know from certain from certain companies and certain sectors, and then extrapolating that out to the rest of the economy based on the size of those businesses and of those sectors in the economy. So that was really, I think, one of the biggest warning signs for the for analysts and economists looking at this. It's okay, the job market is really starting to soften. We're not seeing the deceleration in the stock market. We're not seeing earnings dip. We're not seeing revenue dip, but we are certainly seeing jobs start to taper off, right? And then you can look back at like 2024 numbers, and there were a bunch of games that were played with regards to adding numbers potentially from non-US citizens, and also from the fact that a lot of those numbers were bolstered by government jobs, which you can make the argument it's like that doesn't necessarily add productivity to the real economy. But if you look at the job numbers, that to me is the biggest yellow warning sign that things are starting to look a little bit iffy.
Yeah, and you hear, I mean, I've heard various things. I don't pay super close attention to this. Like, yeah, there's a bunch of revising in all of these reported numbers, which ironically, at some point, you may start to go back to just cultural vibes evaluation. If the numbers don't mean anything, then just look at what the people around you feel like, and then maybe that's the recession indicator. You know, I still tend to lean towards the numbers because it's something, you know, probably it feels like it should be more meaningful. But, you know, like you can only have the ivory tower of economists and federal agencies which reported these things tinker with these knobs so much before you just start to totally lose trust.
100%. All right, I want to zoom in on a few more data points, and then we'll end with looking at rate cut expectations.
And we'll actually end with one of my favorite recession indicators, but we'll get there.
Okay, good. Well, we'll end the data section, and then we'll get back to the fun stuff. So consumer credit continues to rise. This is not something that you would expect to see necessarily moving into recession territory. That being said, just because it is consumer credit, that doesn't make it a good thing, right? I mean, obviously credit tends to grow the economy, but if people are having to take out loans to buy burritos, as you mentioned earlier, you know, not really a good indication that there is a healthy economy out there for the average consumer, right? But consumer credit rose 2.3% in Q2. That was largely driven by 2.9% rise in revolving credit and non-revolving credit, which is things like auto loans, home loans. But revolving credit, it only rose 0.7%. So you might see a little bit of tapering back in, you know, things like credit card use as people are starting to tighten up spending. A few other things. Businesses have had a strong start in Q3, led by services, which is like the majority of the U.S. economy at this point, right? We don't have as much manufacturing. But U.S. business activity rose on the composite PMI from the S&P and from the S&P Global's purchase. That's the S&P Global's Purchasing Managers Index that I'm citing here, rose to 54.6 from 52.9 in July. The quickest growth in 2025. 50 is like the cutoff. If you're above that, you're in expansion. If you're below that, you're in contraction. So far, again, that's not flashing any signs of weakness. But this is the one going back to the material sector that we were talking about in the manufacturing jobs. Manufacturing contracted in July. According to the Institute of Supply Management Purchasing Managers Index, the index fell to 48 in July, down 1 point for June in the fifth straight month of contraction. Only 7 out of 18 industries in that manufacturing sector reported growth on the month. So I think we're really starting to see, obviously, going back to that, tariffs impacting some of these sectors. Their input costs are rising. Maybe they're having trouble moving inventory because the output costs are rising as a result as well. That is another one of those kind of flashing yellow indicators that I think is worth looking at. Now on to inflation data and what people think the Fed are going to do. So one of the reasons, if you were paying attention to Bitcoin sold off today, the day that we're recording this, August 14th. Part of that is because Scott Bessent said that they were not going to buy Bitcoin for a strategic Bitcoin reserve, which is not news. They've been kind of clear about that. I don't know why.
We've covered this on this podcast multiple times. They're like, they're not, we'd be very surprised. Like they've said they're not going to,
yeah. They're going to fund it through theft, which is how you, which is
efficient markets my ass.
Yeah. Personally, I am happy that the U.S. government is continuing its long track record of stealing things from people that it doesn't own. I love paying taxes. I love living in a state with civil asset forfeiture. I mean, it's you know, I if you don't like it, then move, man. But that infected the market. But also the producer price index came out. That is an index looking at the price of goods for producers, manufacturers, etc. And it was a big print. We've been dropping in terms of CPI and PPI into like the 2% range, which is closer to the Fed's mandate, made up number, but closer to the Fed's mandate, but not where we want it to be, which is at dead on 2%. But it rose Core's PPI, which excludes food and energy, rose 3.7% year over year. And headline PPI, which includes food and energy, rose 3.3% year over year. It's the biggest gain since early 2025. Now, these numbers are not indicative of reality either, in the sense that number is actually much higher, right? Any Bitcoiner will know. You look at CPI or PPI, you look at the inflation data. The Fed plays with numbers, and it's not actually indicative of real increases to goods, right? They're going to try to make it look as tame as possible. So you can go ahead and bump that up a few percentage points accordingly. CPI came in also hot in July. So that was the PPI numbers for July. For CPI, headline CPI rose to 2.7% year over year. Core CPI rose to 3.1% year over year. So inflation is still running hot, but that is not stopping the market from thinking that the Fed is going to cut rates during their September meeting, which is the one that comes up next. So this is from CME's FedWatch tool. If you look at what these are basically expectations for rate cuts based on contracts traded on the market. The rate probability for the September 17th meeting is at 92.1% for a 25% or 0.25%, 25 bip decrease to the Fed fund rate. That is the rate that drives interest rates for the rest of the market. It's the rate at which the Fed will lend out loans to banks in its orbit. And if we look at October, they're even more bullish on a rate cut for another 25 bip rate cut in October. 55.2% of market participants think that we're going to be between 3.75 and 4% in October after that. And then 41.7% think that we're going to get 4% to 4.25% interest rate target or Fed fund rate in October. So even with inflation running hot, people think that we're going to get interest rate cuts. And maybe that is true. Trump has been pounding on too late Powell for interest rate cuts so that the US government can refinance debt on it's something like, like $7 to $9 trillion worth of short-term treasuries that have been priced at 4 to 5% when the Fed started hiking rates. Typically, you do not cut interest rates if the economy is strong. Typically, you cut interest rates in response to shortfalls in the economy and if you're trying to boost growth. So that's another indicator where you could look at it and say, something's not really feeling right,
Well, if you're not feeling right, Colin, there's a solution for that. And that is with the drink of the summer, which is a sign of a recession. I'm introducing the spaghetti. I don't know if that's actually what people call it, but it's just Miller High Life with a little bit of Aperol poured in. So because you want to feel fancy, but you can't afford anything. And the way you used to do that would be by buying champagne with the champagne of beers, which is Miller High Life. Now, because it's 2025, we have to add a little twist to it where you put some Aperol in it, gets this beautiful red hue. It makes it a little bit sweeter, makes you feel fancy, and it's also simple to make. So, here's a whole, here's thousands of words on why this is a recession indicator. But there's also a good YouTube video of your token celebrities trying this for the first time and all talking about it being a recession indicator.
This is like the Italian American equivalent of like a Corona Rita, where you like just dunk a Corona into a margarita. I don't know. I don't know who thought to put Aperol Miller High Life.
It's really good.
Is it really? Okay, I'll have to try it because it sounds freaking awful.
Yeah, it's really good. The problem is, I would be ordering this even if it weren't if it weren't a recession. I'd be like, yeah, that's it's a cool, cheap, tasty drink. I'm down.
Cue the video of the Italian DJs drinking Campari.
Yeah, which Campari, just straight bitter Campari. Well,
yeah.
I know just
My wife loves Campari and she loves Negronis specifically, which is the Duke of is a cocktail.
Gin and
gin, Campari, and vermouth. It was popularized by the Duke of Negroni, and very bitter, tastes like cough syrup. Aperol is like a sweeter version of that, but that's interesting. I mean, you got to get your kick somehow.
Yeah,
that would be really interesting to do like a beer price index or like craft beer to industrial beer consumption index to show in a recession whether or not people start dumping their $15 a 6-pack IPAs for like a 30 rack of Coors Light that costs the same amount of money.
We won't have enough data points, Colin, because remember, the craft beer phenomenon is a post-recession phenomenon.
That's
we
true.
Didn't see quite the explosion of mom and pop breweries which burn through all their friends and family's cash and then go bankrupt. We didn't see that happen until after the great financial crisis. So we'll have a single data point here where we can see mom and pop's weird ass, dark ale versus the good old fashioned Budweiser.
Pumpkin chocolate milk stouts in disbelief.
Triple sour cow. Okay.
I think that does it.
That's it. Thank you all for bearing with us. Catch us next week on Bitcoin Season 2. Peace.
It's one Bitcoin, Michael. How much could it cost? $100,000.
You've never actually set foot in a supermarket, have you?
I don't have time for this.